Is Axon merely a hardware company,
Hmm.
just selling tasers and body cams? Or has it actually built this, like, unbreachable digital fortress around public safety that maybe the market is still underestimating? That question, it really gets right to the heart of understanding Axon. And, well, by the end of this deep dive, you'll definitely have a much clearer picture of its true strategic position. Welcome to a special deep dive. We're going to pull apart the layers of a company that has truly, really reshaped modern law enforcement. Axon Enterprise, Inc. It trades on the NASDAQ, ticker symbol AXON.
Right. And our mission today, it's about applying, rigorous business-focused principles to really get under the hood of this fascinating company. We're dissecting its business model, we're evaluating the leadership, scrutinizing the financials, assessing the risks, basically giving you a comprehensive view of its intrinsic worth.
Okay, just so everyone knows, all the insights we're sharing, they're anchored to data and market conditions as of June 27, 2025. On that day, Axon share price stood at $818.60.
All right, let's unpack this part one, the foundation, business, management, and financials. Let's kick things off with a really crucial look at the company's core operations, how it actually makes money. Chapter one, business analysis. So we start with that fundamental question, right? Is Axon really still just a taser company, like in the way most people might think?
That's probably the biggest misconception. The truth is Axon has gone through this, well, profound transformation and understanding that evolution is really the single most important factor here. They've shifted away from just, one-time hardware sales to building this powerful, really comprehensive subscription-based ecosystem. That's the core story now.
Yeah, and the numbers, especially from Q1 2025, they just screen this transformation, don't they? Their annual recurring revenue AR, it surged by a massive 34% year over year, hit $1.1 billion. Right, but what's truly fascinating here, and maybe the real engine of the business, is their net revenue retention, the NRR. It's at 123%. Now think about what that means. For you, the listener, an NRR over 100% means they're growing revenue even without signing up new customers. It's like
Right.
your existing customers are not only staying, but they're spending on average 23% more each year. That's huge. That shows the ecosystem is working.
It creates this, well, they call it a flywheel effect. So an agency, they might start by buying hardware, right, like body cameras, but that naturally means they need the cloud software, like Axon Evidence, for all that data. And once they're in that system, well, then Axon can upsell them. Premium tiers, new hardware like the TASER 10 or the Axon Body 4, maybe AI tools like Draft 1. The result, over 95% of their revenue is now tied to these subscription plans. It really makes them look much more like a top-tier SaaS company, software as a service.
Hmm. And if we dive into their actual offerings, Axon basically breaks it down into two main segments. There's smart weapons, that's the TASER division, and then software and sensors. On the smart weapons side, you've got the flagship TASER 7 and the newer, more advanced TASER 10. Then in cameras and sensors, there's the Axon Body series, Axon Fleet for in-car video, and even Axon Air, which brings drones into the mix for public safety.
Yeah, but the real, connective tissue holding it all together is that software suite. Axon Evidence is the core platform for managing all that digital evidence. You have Axon Records, which streamlines incident reporting, and Axon Respond for real-time operations. And what's really pushing the envelope is their move into AI and VR. Take that AI tool, Draft 1. It can automatically generate police reports from body cam audio. That cuts officer paperwork by, get this, 6 to 12 hours per week. That's not just efficiency, is it? That's a massive operational improvement for departments.
It absolutely is a game changer. And looking at their market position, their scale, Axon is pretty undeniably the global public safety technology leader. They've got a market cap of $63.7 billion. They serve over 17,000 state and local agencies and support more than 1 million software users. What's also key for you, the listener, is how they're expanding. They're moving into adjacent markets, federal agencies, corrections, fire, EMS, even enterprise security. That really broadens their potential customer base.
So ultimately, Axon's main value proposition. It sounds simple, but it's powerful, enhancing safety, efficiency, and trust in public safety.
Exactly. And they've got tangible results to show for it. We mentioned the Draft 1 efficiency gains, but also deploying Axon cameras and tasers in correctional facilities. That's been linked to a 70% drop in excessive force claims. Their mission statement really sums it up. Protect life, capture truth, accelerate justice. It's a strong message for their customers.
Okay, shifting gears a bit to the industry itself. This market, it's just huge, isn't it?
Yeah.
Axon estimates its total addressable market, the TAM, at a massive $129 billion. And there are huge chunks within that, like digital evidence management at $41 billion, real-time operations at $20 billion, AI stuff at $17 billion. It's enormous potential.
Yeah, and what's really key here for you listening is how little of that market they've actually penetrated so far. They're currently getting less than 1% of the average customer's budget, but they see potential to reach 3% just by getting customers to adopt more premium products and integrate deeper. That suggests a really long runway for growth. Plus, this market is remarkably resilient. Public safety spending, it's shown pretty durable growth for like 40 years, less prone to typical economic ups and downs.
Now, competition. When we look at who they're up against, it really boils down to a clash of titans, doesn't it? Axon versus Motorola Solutions, MSI. Motorola is, well, significantly larger, very well financed, and yeah, they often compete hard on price.
They do, but Axon isn't just, standing still. Their Axon Body 3 camera actually outperformed Motorola's in a 2023 DHS assessment. And maybe more strategically, Axon bought Fusus in early 2025. That's a direct challenge to Motorola's long-held dominance in CAD systems computer-aided dispatch. With Fusus, Axon's trying to become that central hub, that nervous system for policing, integrating all sorts of data. It's a very calculated move to build out their ecosystem.
The regulatory side is also, well, it's complex. There's no federal mandate for body cameras right now. State laws are all over the place. Only about 8 states actually require them.
And for tasers, there's that Armstrong v. Village of Pinehurst ruling, which kind of limits their use to situations of immediate danger. But this complexity, interestingly, it almost creates a barrier to entry. It favors established players like Axon who already know how to navigate these tricky legal and policy waters. It makes it harder for new guys to jump in.
Which brings us neatly to Axon's competitive advantage. Its moat, as they say. The first big piece has got to be those high switching costs, right? I mean, just think about it. Trying to migrate petabytes of critical video evidence from Axon evidence to some competitor. That's not just a technical headache for an agency.
It's a nightmare, a legal and financial nightmare. Absolutely. That's a huge part of their defense. And then you add the network effects. The more agencies that join the Axon network, the more valuable it becomes for everyone, right? Because they can share evidence seamlessly, securely between jurisdictions. That gets stronger with every new customer. It's a classic network effect, really hard for rivals to copy. Plus, you have their brand strength. TASER is practically generic now, their scale allowing huge R&D spends, unique patents, and this massive data set they have for training AI. It's a really strong position.
Okay, so we've looked at the business. Now let's shift focus to the people running the company. Chapter 2, management evaluation. All right, let's talk leadership. Rick Smith, he's the founder, CEO since way back in '93, clearly driven by this big mission, right, to make the bullet obsolete. And importantly, he owns about 4.6% of the shares. That's worth roughly $2.9 billion. So, his interests seem pretty well aligned with shareholders.
Yeah, and what I find quite impressive is how proactive they seem to be about potentially tricky issues. For example, they set up an independent Ethics and Equity Advisory Council, EEC, back in 2022. That council gives them guidance on developing tech responsibly. That, plus their formal human rights policy, it shows they're taking ethical considerations seriously, which, let's face it, is crucial in this market. There's also publicly stated they won't put real-time facial recognition in their body cams, addressing a major privacy worry head-on.
Right. And they seem pretty transparent with investors, too. Internal morale looks strong. Something like 87% of employees think management is honest and ethical. Now, capital allocation. Axon's strategy here is clearly all about aggressive growth. They're pumping money back into R&D, especially focusing on AI and drones. They even issued, what was it, $1.75 billion in senior notes in Q1 2025, primarily to fund that growth and big acquisitions like Fusus.
Which naturally brings up a key question for investors. What about returns to shareholders, like dividends or buybacks? Well, Axon doesn't pay a dividend right now, and there's no major share buyback plan. That's pretty typical, though, for a company growing this fast and reinvesting so heavily. But importantly, their normalized return on invested capital, the ROIC, it's a healthy 14.92%. If we connect this to the bigger picture for you, the listener, well, this is basically the textbook definition of a compounder, a company that can reinvest its earnings consistently at high rates of return. And that big $1.75 billion debt raise, it signals real conviction from management that they can put that capital to work and generate similarly high returns.
Okay, it makes sense. Now let's get into financial details. Time to crunch some numbers. Chapter 3, financial analysis. All right, the numbers. Axon's financials, they really paint a picture of, well, explosive growth, strong underlying profitability, and honestly, a rock-solid balance sheet. As of that June 27, 2025 date, their market cap was sitting at $63.7 billion. And the revenue growth has just been spectacular. I mean, we're talking over 13 quarters in a row, more than 25% growth. Annually, it's consistently strong, 28.3% in 2020, ramping up to 33.4% in 2024. And Q1 2025, revenue was up 31% year over year. Again, just wow.
Yeah, the top line is impressive. Now, profit margins tell a slightly more nuanced story. Gross margin, consistently high, around 60, 61%. That signals really strong pricing power. But operating and net margins, those have been more volatile. Why? Well, mostly due to those heavy R&D investments we talked about, and also significant non-cash stock-based compensation, or SBC. So for you, the listener, what this means is a chunk of their cost isn't cash going out the door, it's equity given to employees. This can dilute existing shareholders a bit and makes the reported GAAP earnings look lower than maybe the core operation suggests. To get a clearer view of that core profitability, it's probably best to look at their adjusted EBITDA margin. They're guiding that to be around 25% for 2025. That reveals a highly profitable underlying business.
Okay. And free cash flow, FCF.
Yeah.
It's positive, but like you said, it can bounce around a bit because of those heavy investments. They did generate $330 million in FCF back in 2024. And management's goal is to convert over 60% of that adjusted EBITDA into free cash flow eventually.
Exactly. Now, looking at financial stability, Axon has been consistently profitable on a GAAP net income basis for the last 3 full years, 2022, 23, and 24. Their debt-to-equity ratio did jump up to 78.5% in Q1 2025, but that was almost entirely due to issuing that $1.75 billion in senior notes for growth. But here's the key. Their liquidity is exceptionally strong. Current ratio was 2.83 in Q1 25 plus, and this is a huge, plus they're holding $2.37 billion in cash and short-term investments. That actually exceeds their total debt, so they're in a net cash position, essentially more cash than debt. That gives them incredible financial flexibility and resilience, and yeah, no dividends, reflecting that reinvestment strategy.
Okay, solid financials, amazing growth, but now the critical piece for a lot of our listeners, valuation. How does all this translate into the stock price? Because let's be honest, Axon trades at an exceptionally high premium.
It really does. That's the elephant in the room. Its trailing 12-month PE ratio, it's somewhere in the range of like 133 to 196. That is vastly higher than the average for its industry, aerospace and defense, which is more like 38 to 47 times earnings. A multiple like that, it's pricing in extremely high expectations for future growth. Perfection, almost. So to look beyond just comparing multiples, we often turn to intrinsic valuation methods, like the discounted cash flow, or DCF model. The basic idea there is you project the company's future cash flows way out into the future, and then you discount them back to today's value to get a sense of what the business itself might be fundamentally worth.
Right. So given that sky-high valuation, it feels like the market isn't just betting on Axon's future. It's almost demanding flawless execution. What does that kind of pressure mean if, say, they have even a minor stumble?
That's exactly the challenge, isn't it? If you run an educational DCF model, even using what you might consider conservative long-term assumptions, let's say, hypothetically, 25% growth for 5 years, then tapering down to a 3% perpetual growth rate, maybe FCF margins expanding to 20-25%, and you use a discount rate of 9-11%. Well, a model like that would likely spit out an intrinsic value somewhere in the range of, say, $450 to $650 per share. Now, compare that to the current price of over $800. It really highlights a potentially significant gap between the current market price and a more fundamentals-based valuation. It tells you just how much future success is already baked into that stock price today.
Okay, a lot to think about on the valuation front. Let's now move into how the market itself is viewing Axon and who actually owns the stock. Part 2. Market signals, ownership, risks, and conclusion. Let's kick off this second part by looking at the broader market sentiment surrounding Axon. Chapter 4. Market sentiment.
So, Wall Street. What are the analysts saying? Well, the sentiment there is overwhelmingly positive. We're seeing a consensus strong buy or buy recommendation from about 91% of the analysts who cover Axon.
Yeah, very bullish. And the average 12-month price target from those analysts, it's sitting around $735. The range is pretty wide, though, from about $610 on the low end up to $895 on the high end. The media coverage tends to mirror that positivity, too. Lots of focus on strong earnings, new AI product launches. The main note of caution you hear again and again is just that high valuation.
Right. And if we look at other market indicators like short interest, that's usually a sign of people betting against the stock. For Axon, it's remarkably low, only about 1.79% of the float. And the days to cover is only around 2.5 to 4 days. Basically, very few big players are shorting Axon. And technically speaking, looking at the chart, Axon's share price at $818.60, is trading significantly above its 50-day simple moving average, which is around $709. And it's dramatically above its 200-day moving average, which is closer to $585. What that signals is extremely strong positive momentum. Buyers are clearly in control across both medium and longer-term timeframes. The demand for the stock has been very robust.
Okay, strong momentum. Now let's dig into who actually owns Axon shares. Chapter 5, ownership structure. Right. Ownership is pretty dominated by large financial institutions, isn't it? They collectively hold somewhere between 80 and 82% of all the shares. The really big names are there. Vanguard, BlackRock, State Street. That makes sense partly because it's included in major stock indexes, so index funds have to own it.
Right. But importantly, company insiders, including the founder and CEO Rick Smith, they still own a pretty substantial chunk, about 4.6%. Now, that's worth around $2.9 billion. For you, the listener, this is generally seen as a really strong positive. It means management's financial interests are deeply aligned with other shareholders. They win when you win.
But here's where it gets kind of interesting when you look closely at what insiders are actually doing with their shares. For you, the listener, this is worth noting. While there's been a fair amount of insider selling, it looks like 81 sales versus only 15 buys in the last 12 months. And a lot of that selling is probably automated, preset trading plans. There's been a complete absence of any significant open market buys by insiders, especially at these recent high price levels.
Yeah, and that does raise an interesting, maybe subtle question. If the people who arguably know the company best aren't stepping up to buy shares on the open market at these prices, what might that suggest? It doesn't necessarily mean anything bad is happening, but it kind of aligns with that broader concern we discussed, that maybe the stock's valuation has gotten a bit stretched even from the perspective of those running the company. It's a data point to consider.
Definitely food for thought. Okay, before we wrap up with our conclusion, let's tackle the potential roadblocks and opportunities ahead for Axon, the risks. Chapter 6, risk assessment. All right, let's do a quick SWOT analysis. Strengths, weaknesses, opportunities, threats. Starting with Axon's strengths, their core internal pluses. Clearly, they have a dominant market position, iconic brands like TASER, Axon, that integrated ecosystem we keep talking about, creating high switching costs, powerful network effects that leads to high margin, predictable recurring revenue. They've got visionary founder-led management, and as we saw, a really strong net cash balance sheet, giving them lots of financial flexibility.
Okay, weaknesses. Well, the most significant one, we have to say it again, is that extreme valuation premium. A PE pushing 200x. That leaves zero room for error, really. Any misstep could hit the stock hard. Also, that heavy reliance on stock-based compensation, while common in tech, does dilute existing shareholders over time and can make the GAAP earnings picture look a bit murky. And, in this industry, public safety, law enforcement, there's always inherent reputational risk. If a product fails or there's an ethical controversy, that could be damaging.
Makes sense. Now, opportunities. We talked about that massive $129 billion TAM, total addressable market, with really low penetration currently. Huge room to grow there. Plus, expansion into new international markets, new customer types like federal agencies, enterprise security. That opens up more avenues. And, of course, continued growth driven by new tech, AI, drones, real-time operations, all aimed at replacing those old, clunky legacy systems that many agencies still use.
Right. And finally, the threats. External factors. Intense ongoing competition, primarily from Motorola Solutions. That's not going away. The regulatory landscape is always shifting, creating uncertainty. Potential for product liability lawsuits is always there. And the risk of public backlash over things like privacy or how AI is used ethically. Macroeconomic factors are a threat too. Because they rely heavily on government budgets, they're somewhat vulnerable if inflation stays high or interest rates keep rising, potentially leading to delayed spending by agencies. And then there are geopolitical risks. Specifically, potential U.S. tariffs may be coming in 2025 on imported electronic components from places like China or Taiwan. That could directly squeeze their hardware profit margins.
Okay, so those tariffs, that sounds like a direct hit to their hardware business. What does that really mean for the company going forward?
Well, this is where Axon's strategic shift really matters. If we connect this threat to the bigger picture, that pivot towards software acts as a pretty significant hedge. Why? Because high-margin software and services, they're generally exempt from those kinds of hardware-focused tariffs. And crucially, remember how software is growing faster? 39% year over year compared to 26% for connected devices. That means the part of their business that is vulnerable to tariffs is actually shrinking as a percentage of their total revenue over time. So that strategic focus on software provides some real resilience against these global economic shifts and trade policy risks.
Got it. Okay, let's try and bring all these pieces together now for our final thoughts. Chapter 7, Conclusion. All right, let's synthesize all this. The bull case for Axon is pretty straightforward, isn't it? You've got an exceptionally high-quality business here. It has a dominant, almost monopolistic position in its core markets, protected by a really formidable moat, that ecosystem, the network effects, the high switching costs. It's got a high-margin subscription model throwing off predictable revenue with that stellar 123% net revenue retention. It's led by a visionary founder who's targeting a vast, still largely untapped market. By almost any measure, it's a best-in-class operator.
Absolutely, but a bear case. It really has very little to do with the quality of the business itself. It's almost entirely about the price you have to pay for that quality right now. That astronomical valuation, the PE near 200x, it simply prices in perfection. Flawless execution, continued hypergrowth. It's all expected. Any stumble, any deviation from that path could lead to a really severe repricing of the stock. The risks we discussed are real. Fierce competition from Motorola, potential reputational damage, vulnerability to government budget cuts. And as we noted, that pattern of consistent insider selling combined with a lack of significant open market buying, it's a subtle but maybe telling signal that even those closest to Axon might not see the current price as a bargain.
Yeah. And just to reiterate, the output from that educational DCF model we discussed using conservative long-term assumptions, it suggested an intrinsic value range more like $450 to $650 per share.
Exactly. So as of June 27, 2025, Axon Enterprise is trading at $818.60 per share. The bottom line, while the business itself is exceptional, truly high quality with a clear growth path ahead, that quality is arguably more than reflected, maybe even exceeded, by its current market valuation.
So for you, the listener, the ultimate question really isn't about whether Axon's a great company. It clearly is. The question is about the price you're willing to pay for that greatness. And critically, how much future growth you believe is already baked into that $818 stock price. If you found this deep dive valuable, and we hope you did, please do us a favor. Like this video and subscribe to the Stock Analytics AI YouTube channel. It really helps us out.
And remember, for just $4.99 a month, members get priority deep dives on tickers you request. Plus, over the next few months, we're planning to cover all of the S&P 500 stocks. Members get exclusive priority access to those as they come out.
Yeah, don't miss out on that. And hey, if you just want a one-off deep dive into a specific stock that's caught your eye, just drop us a super thanks on YouTube.
Okay, one last crucial reminder before we go. This analysis was generated by an AI system. It's purely for educational purposes and should absolutely not be considered financial advice. Always do your own research, or better yet, consult with a qualified financial advisor before making any investment decisions.
Right. So after all this analysis, what do you think? Has Axon truly built that unbreachable digital fortress around public safety? Or is the market perhaps already seeing it that way, maybe even a little too optimistically? It leaves us with a fascinating thought, doesn't it? In this age of incredibly rapid technological change, how do we actually tell the difference between genuine underlying intrinsic value and just, seemingly limitless enthusiasm for future potential? Keep asking those questions. We'll keep digging for answers.